Good afternoon, everybody. I think we'll make a start. My name's Norman Gimmel. I'm Chair in Public Finance at Victoria University. So it's my privilege on behalf of the University and the Government Economics Network, who are jointly sponsoring this event, to welcome you to the debate this afternoon. I should also both welcome you on behalf of PwC and thank PwC for making available the room and for the support that they have given us for this event, both through the staff who are helping us today and for Chris Money, who's going to be involved in the presentations. So welcome to you and thank you very much to PwC. Can I just remind you to turn your mobiles to silent? I'm sure many busy people here who need to keep in touch, but if you can have it vibrate rather than ring, that would be helpful during the next hour or so. And a couple of housekeeping things. I'm sure, apologies for those of you who've been to several events before, but there are some I know who've not been before. We operate a Chatham House rule on these debates, which basically says that you can report what was said, but you can't report who said it, which might seem a little odd for the presenters. So that rule applies to all of you speaking from the audience when it comes time to throw questions and vociferous comments to the presenters later on in the afternoon. But also, if you want to report what the presenters say, and the results of their slides and so on will be available on the web, we would ask that you talk to them first to get their permission before you quote them in any sense. And the reason we ask that is that I've explicitly asked the presenters to make a case for and against a particular proposition. They're not necessarily expressing their own view. In the case of Chris, we've asked Chris to do a kind of middle ground assessment of whether he thinks the proponents and the opponents' propositions seem the more plausible, or what are the pluses and minuses of what they have to say. So I'd be grateful if you would bear that in mind. So for those of you who haven't been before, the format is that we have a proposition, which is that it's time that New Zealand extended charging for public infrastructure. And Geoff Cooper, who I'll introduce to you in a minute, is going to make the case for the proposition. He's got 20 minutes to do so. And if he dares to run over time, we have a bell ringer who will persistently remind him that his time is up. After that, I'll ask Peter Conway, who's going to present the arguments against that proposition, that it's not time we started charging for public infrastructure. And after his allotted 20 minutes, we'll ask Chris to do a quick, as it were, appraisal and introduction. And then it'll be time for you to pass your comments and questions. I should say as well that we're recording their presentations, but we'll turn off the recording at Q&A time. So you're free to make whatever comment you like without fear that you're going to somehow be on tape at the same time. So let me introduce you to the three people who are going to present today. Geoff Cooper, many of you will know as Chief Economist at Auckland Council. Before that, he was Chief Economic Advisor at the City Council before it was Auckland Council. And Geoff, in his current role, provides advice, economic advice primarily to the council executives, to the council, and also I noticed on his website indicates that he provides information on major investment and environmental threats and opportunities. But Geoff has a bachelor's in commerce and science, a joint bachelor's from Auckland University, and he has a master's with first-class honours in economics. You might also be interested to know that Geoff was a finalist for the Young New Zealander of the Year in 2010. It's a long time since I might have been eligible for that award. And in 2012, he was a finalist for the New Professional of the Year in Public Administration. So welcome, Geoff, and we look forward to hearing what you have to say. Peter Conway, again, many of you will know Peter as Secretary of the CTU, which he has been since 2009. But for the previous 9 years, Peter was the CTU Chief Economist and Director of Policy. So again, well qualified to comment on matters of economic policy, especially with relation to things like infrastructure and labour markets. So I won't tell you of all the various unions that Peter has worked for or worked with, but he has a long history of working with a number of unions. But also he has a qualification, he has a Bachelor in Commerce and Administration and an MA in Economics. So as an economist, it's nice for me to see we've got a number of economists participating in the debate. And then finally, Chris Money is Director here at PwC, as well as having several years of experience in economic and financial advice at PwC. He was previously at the Treasury, and in particular he was in their budget and macro economic branch. He was also at the Ministry of Transport, Land Transport Investment and Development Group. So once again, not only in Chris's role here at PwC, but also in his policy background, he's someone with an interest in infrastructure. So we look forward to hearing what they've got to say, and I'll just mention at the end, again, if you're not familiar, we tend to take a vote at the end of the debates. This time we're going to make it slightly different. I'm going to ask you to vote twice, which is kind of the way they used to say Irish elections took place, except everybody voted twice, or at least twice in the one election. I'm going to ask you to vote, first of all, on which presenter you found most convincing, which is a bit of a challenge to both Peter and Geoff. We'll let Chris off the hook on that one. And then I'm going to ask you to vote which of the two propositions you would support if these were the only two options you had to support. So we'll do that at the end. But first of all, it's a pleasure to pass over to Geoff, who's going to get us started, I'm sure, with a controversial welcome introduction to the debate. This assumes that I can get this to move to the right. We need another thing up here, Cherry, is that right? Let me see if we can get this going. There we go. Geoff, over to you.
Okay. All right. Okay, is my time started, is it? Let me know.
As soon as you open your mouth, you'll probably start.
All right, okay. Look, it's great to be here in Wellington, and a former home of mine from some time ago as well. And it's also great to be speaking about road pricing and congestion charging, because if high house prices and crime and other perceived city-specific problems are a source that turns the great urban advantage of density and connecting people into discomfort and urban stress, then traffic congestion eliminates that advantage altogether by bringing people to a complete grinding halt. The speed of communication is a city's greatest asset, and without it, urban centres are no different to their rural counterparts. And because urbanisation is happening at such a great rate, both in New Zealand and abroad, this is happening because it's making people better off. And congestion is one of the costs associated with density. If our cities are to be successful, then winning the war over congestion will be paramount. But far from starting this story in the streets of Wellington or on the highly congested southern motorway of Auckland, I'm going to start this argument for road pricing and the charging of transport infrastructure in Soviet Russia, where bread prices and other consumables were fixed below the market price, and as a result there were stockouts and long lines. Bread was rationed through the mind-numbing process of queuing. And I somehow think that this is similar to how New Zealand runs its transport policy, much like Soviet Russia and its bread policy. Private vehicle users are charged below the market price, and the result is that we ration road price through the mind-numbing process of queuing. Queues that are getting longer, larger and more costly for this country. So over the course of the next 20 minutes, I'm going to explain to you how all of the benefits of road pricing are similar to that of pricing bread, and that just as Soviet Russia eventually embraced the market for bread and pricing of bread, so too should New Zealand embrace road pricing. There's a significant funding shortfall going on in transport infrastructure at the moment, and it's largely up in Auckland perhaps, where the Mayor has led a group called the Consensus Building Group up there. And there's no doubt that a lack of funding for transport infrastructure is certainly a political impetus for looking at road pricing. But it should not be the economic impetus for looking at road pricing. So this is the final word that I'll mutter on road pricing for collecting more revenue, aside from perhaps putting around a collection plate at the conclusion of this debate. Rather, I'd talk a little bit more about economic efficiency. And as economists, I think we need to separate out the quantity of tax revenue collected from how we collect that revenue. This is a debate on the latter. Congestion charging would raise about $250 million per annum in Auckland, depending on the scheme. That's about the equivalent of 20% rates reduction. And this is how I would encourage you to think about it for the remainder of this debate. The fiscal envelope, ladies and gentlemen, is closed. So what now is then the case for road pricing? Well, Auckland is growing. It is growing faster than any other city in New Zealand. It adds an additional person every 20 minutes, compared to every 2 hours for Christchurch, every 2.5 hours for Wellington, and more than 6 hours for Dunedin. And as you might expect, this is consuming a great deal of attention, particularly in the transport space, where we're planning on spending between $60 and $70 billion worth of transport investment over the next 30 years as part of the Auckland Transport Integrated Transport Program. And what you may be concerned to know about this is that with $60 to $70 billion of investment in the Auckland network, congestion does not get better. In fact, it gets worse. Here's two pictures. One on the left is the current network, on the right is the future fully funded network. Red and black are bad, and there's more of them on the right than the left. But this is not a failure of the transport program. It's a reflection of the fundamental law of congestion. Addressing congestion using only supply is like dealing with obesity by loosening your belt. Giles Duranton and Matthew Turner found that in the United States, vehicle kilometres travelled increases 1-for-1 with interstate highways built in US metropolitan areas. If you build it, they will drive. And the more they drive, the more the entire network will slow down. And indeed, this is what we see over the next 5 years. The current average speed in Auckland city centre is in the order of 17 kilometres per hour. And by 2021, that average speed will drop to 8 kilometres per hour. And if you slow cars down, then you're slowing public transport down, because they both use the same land. And since there's very, very little land left for transport investment in places like Auckland city centre and other metropolitan areas, then the next best alternatives tend to be knocking down buildings or getting rid of footpaths. And having spoken to urban designers in Auckland Council on this matter, they're none too pleased at the prospect of that. Now, according to a study by Motu done in 2008, the average value per worker of somebody in Auckland city centre, the CBD, is more than twice as high as the rest of New Zealand, as a worker evaluated in the rest of New Zealand. So these sorts of areas are critical to New Zealand's productivity, right? And being able to access these areas is not just important for Auckland or Wellington, it's important for the whole country. And so putting the discussion of how we make sure these areas are accessible becomes of paramount importance. Here's the economics of it. Private vehicle owners only consider private costs and benefits. When I get in my vehicle, I consider time, I consider the fuel cost from getting to A to B, I might even consider depreciation and maintenance on my car vehicle. But I don't consider how my actions are slowing everybody else on the network down. And let's call this the marginal external cost. Not all trips on the network create the same marginal external cost. Okay. Now, interestingly enough, New Zealand does have a demand management system already in place, right? It's called a fuel tax, and the fuel tax is a distance-based road pricing scheme, right? There's three components to any road pricing scheme. It's either distance, area, or time of day. And New Zealand's stuck with a distance scheme. And what that means is that we assume that the distance driven by anyone on the network is a good proxy for costs incurred. But driving on Auckland's Harbour Bridge at 2 in the morning is not the same as driving on Auckland's Harbour Bridge at 8 AM. One of those journeys is creating the need for an additional harbour crossing, and one is not. And that's what we see here. So this is, I think, a study from the UK that shows this quite elegantly. Now, the deep purple line there is the cost, the marginal external cost of the next driver on a network, right? The light purple line is the pricing mechanism of a fuel tax, used to proxy whether or not that price is included in the decision. And you'll see there that the deep purple line is largely zero for most of the time, right? Up to 50% of the time, it's still zero, because the car driver's getting on the road, it's free flow, it's 2 in the morning, it's whatever it is, there's no congestion, so it's fine, there's no marginal external cost. And indeed, that more or less the same up until about 70 or 80% of all trips taken. But when you get to the top 20% of those trips, the marginal external cost jumps up incredibly and ranges between, this is UK, 50 pence up to £2.50. And this increase that happens because of congestion, people coming onto the network and slowing it all down, means that the mechanism of fuel, using fuel as a pricing mechanism, becomes completely inefficient and ineffective, essentially, because it's not capturing the marginal external cost. So road pricing, completely ineffective. So road pricing is about getting those 10 to 20% of cars off the road so that the rest of the road can be gridlock free. And that's what road pricing is about, which was precisely what Stockholm did in 2007. And this photo here is taken the day before and the day after a road pricing scheme was put in place. And you'll notice that on the left there's a lot of cars, and on the right there isn't a lot of cars. But far from taking off all the cars on the road, in fact all this road pricing scheme did was take 1 in 4 cars off the road. So by taking a few cars off the road, you can go from complete gridlock to complete free flow. And that's what road pricing does. And you can imagine what the transport planners were thinking on the left there. We need more roads, there's a supply constraint, and on the right there the transport planners are now thinking we don't have a supply constraint, and the savings that will come along with that as well. So by getting rid of a few cars, you can go quickly from gridlock to free flow, meaning that congestion is something we put up with by choice. One cunning way to reduce traffic without reducing the number of people travelling across a stretch of road is through carpooling, right? And roughly 30,000 cars come into Auckland city centre every day in the AM peak with a capacity of about 120,000, right? But 120,000 people don't make their way into the city centre each day. Only 40,000 come in, which means 2/3 of the traffic is spare capacity. Now many urban areas, what this means is that many urban areas don't actually have a supply problem as such, they have a capacity problem. Now this is sort of convenient for the road pricing advocates because road pricing places a value on space, and that means it places a value on the space in the car that you're not using. And so it's common to see when you have road pricing schemes implemented that carpooling increases as people move to a different alternative for transport. And this is by no means a bad thing for Auckland where we have such a large amount of capacity available. But of course there's a number of different intricate arguments for road pricing. I can't hope to put forward all of them to you here this evening. But what I can do is say that we should only do road pricing if the benefits of doing this outweigh the costs. Which is lucky because just about every economic assessment of road pricing the world over comes to the same conclusion. Road pricing improves welfare, and indeed you can see the results here of the Ministry of Transport study where they looked at single cordons, double cordons and area charge road pricing schemes all over 1 and sometimes getting up above 3. And Auckland Council repeated these studies and brought the motorway network road pricing design into the mix as well. And if you go overseas, you see that there is an avalanche of different studies which show that there are net welfare benefits for road pricing everywhere. And whilst they are difficult to implement initially, there is scarcely a single scheme around the world that once implemented has been canned. And I think this is a sign of the success of road pricing around the world. In fact, I think that the debate should not be whether we do road pricing, but what the design of road pricing is. And in some ways, as I said, we actually already have a sort of diluted, watered-down road pricing scheme in the form of fuel tax, which is distance-based, and taking that a bit further is a small step, I think. But if you're not convinced by those time-saving benefits and the ease of getting around the city and the productivity that comes with being able to move around urban areas more gracefully and easily, perhaps you'll be interested in the savings to unnecessary infrastructure. If we take people off the roads, it means we can make more efficient use of space, and demand for new infrastructure will diminish. So let's have a look at this. Do we need a $5 billion new bridge, or will road pricing do? Well, the current capacity and current flow over Auckland's harbour bridge is about 60 million vehicles per year in 2008. By 2026, that's forecast to increase to 72 million. Now, if we add in a second bridge or a second tunnel at this point, that'll go up to 90 million. But you've got to pay for this, right? And so many people suggest that why don't we put a tax on it? So okay, let's put a $2 tax on one of the bridges. And if you put it on one bridge, you've got to put it on the other bridge as well. So we'll put it on both bridges. The demand for flow across the bridge falls all of a sudden down to 67 million, which is basically what the capacity is at the moment. And if you put $4 onto that, it reduces down to 50 million, which is below what the current capacity is currently. And interestingly enough, that's exactly what the capacity was in 1995, almost 20 years ago. So road pricing could push the need out for a $5 billion piece of infrastructure, or $3,400 for every man, woman and child in Auckland, out 20 years, which begs the question, new bridge or road pricing, which is more effective? And what other projects are there that could be saved and delayed? But if you're still not convinced by road pricing, Perhaps this one will do it for you. The current system is completely unsustainable. The current system relies on people using fuel, and people are using a lot less of it. Electric vehicles are coming, and that poses a dramatic problem, I think, for the current system. And if we have a look at a UK study that was done on this, they showed that the amount of fuel collected, fuel duty expected over the next 20 years is expected to diminish significantly. And this is not because people are driving less. In fact, people are driving far more than they ever have. Total annual distances are expected to increase from 516 billion kilometres a year to 637 billion by 2030. They're driving more, they're paying less, and that is unsustainable. There's two reasons why this is happening. The first is that fuel efficiency means that fuel consumption is declining, and the second is that by 2030, 85% of all new vehicles are forecast to be exempt from fuel altogether. I want to end by talking a little bit about social equity and road pricing, because there's an argument out there that says that road pricing is regressive. And I think that whilst I'm sure we'll hear a bit about that in a second, I don't think we should pay it too much credence. And this here is Ken Livingstone from London, who's a left-leaning mayor and responsible for bringing in the London congestion scheme in the early 2000s. And Ken saw road pricing as a progressive tax rather than regressive, and he had a few reasons for this. First is he felt drivers were more wealthier than people that were using public transport. And he also thought that if you had good alternatives in place and designed a road pricing scheme around those alternatives, that it need not be regressive. And I think we need to make no mistake here. Road pricing will not work unless you have alternatives in place. You won't be pricing people off the road, you'll be pricing people on the road if you don't have alternatives. And that is critical. And places like Auckland trying to do this right now through electrification, the redesigned network, public transport network, and transport investment. And of course you can also exempt things like carpooling from the alternatives, or more importantly you could reduce rates, as I said, by 20%, and you could use the annual uniform general charge to give back those to lower socio-economic groups. Yet another reason why road pricing doesn't need to be regressive. But these are all peripheral reasons why we should think that this is actually less regressive than the alternatives. And that is that the current scheme, the current system that we have in place is far more regressive than road pricing. The current system forces people to pay regardless of the time they drive, regardless of the costs they're creating on the network. Whereas road pricing creates an opportunity for people to avoid paying costs by driving outside peak times. And road pricing is only at peak times. So when we asked households with income between $30,000 and $50,000 between them, 55% of them supported road pricing if it came with less congestion. This is an area where equity and efficiency can and should go together through good system design and good alternatives. And indeed, I think we should care deeply that any road pricing scheme implemented is not a significant burden on lower socio-economic groups. But we should consider the role of this relative to the current system rather than thinking about it on top of the current system. Because as I said, it's a fiscally neutral idea, and I think the poor could well pay a lot less under a fiscally neutral road pricing strategy. So there's a whole bunch of reasons. I invite you to take your pick over which one you find sort of most encouraging to you. But I think road pricing summed up in 8 different ideas. The first is that it improves travel times. And it does that not just everywhere, it does it in the most important productive areas of New Zealand's cities. And that is another benefit of it. It also takes advantage of spare capacity through carpooling, and almost always has a positive cost-benefit ratio, which is rare when you're considering how to raise tax. The idea that you can have a tax-raising mechanism which actually improves welfare is quite unique to road pricing. It's also a sustainable system of revenue collection. It's less regressive than the current system, and it's more efficient because it charges people who are actually creating the costs. And lastly, it avoids unnecessary infrastructure costs, all of which begs the question: is pricing bread, or is pricing roads really that different to pricing bread? Thanks very much.
Thank you very much, Geoff. As you saw Peter looking quizzically and writing on his notepad from time to time, that's because this is the first time Peter has seen what Geoff had to say. As an opponent, he wasn't allowed to gainsay what the proponent was going to say. So the same applies in reverse. Geoff will not have seen what the opponent has got to say, but no doubt they'll have a chance to battle with each other later on. So, Peter, over to you.
Thanks very much. That was fortunate that Geoff focused also on transport infrastructure, because otherwise I could have been talking about sewage, and he was talking about road pricing. So that was very good that we both went down the same track. So my main arguments here are that if an infrastructure project can't meet a public interest test, then it shouldn't proceed. The equity issues with road pricing, with charging, are significant. And while it's possible to say that you can have tolls without a private sector partner, there are risks that charging options will skew the debate around infrastructure projects, and I also argue there's major implementation risks. And I do note that the World Bank finds that with most toll roads, the private sector has been heavily involved. As a little bit of insurance, if my arguments are not convincing, I've suggested some mitigation, and I also propose some alternatives in terms of both financial and congestion issues. So transport infrastructure is hugely important for long-run economic and social development, and if we accept that agglomeration can underpin higher productivity and economies of scale, then major public investment has very significant externalities. Public because it's non-excludable, non-rival, but charging undermines this rationale. You could argue that we face this situation because of historic underinvestment in public infrastructure and a bias towards low rates and small government. I also argue that we should not take an individual user approach to infrastructure. These are collective goods where people derive collective benefits, and to single out user rates and marginal pricing elements in this, I argue, is wrong. We should look at collectively around infrastructure, and there will be individual swings and roundabouts in terms of usage. Now, obviously run the risk of carrying that argument too far. We have multiple tragedies of the commons. So this debate, of course, occurs in a context where the government says it will sell equity in public strategic assets to fund hospitals and schools, and where the Dom Post argued in the paper last week that Chorus should be publicly owned. Now, there's plenty of charging options, and Geoff was right to say that we've already got charging now on a distance basis. And there's examples such as development levies that are also very much in the literature about this, and there's examples around Tauranga and so forth, and that's to reflect higher property prices and values and business benefits, but as the Productivity Commission noted, also impact on housing affordability. And the Auckland Consensus Building Group seemed to narrow down to single cordon and a motorway network charge. So, unsurprisingly, Geoff was right, got that prediction. I am going to talk about equity. And there's several angles. And I've lived in London a few years, Geoff, you may have as well. It's kind of a different place when it comes to transport options. I never bothered even thinking about owning a car for the several years I worked there. And the equity issues are therefore different as well. So I'm focusing mainly on income, and the main part of my argument is that inequality by now is such a major issue that it's relevant to just about any social policy debate or any debate that you can think of. The bottom half of people have 5% of the wealth. The bottom half of people have 5% of the wealth. That's the status that we've got in this country. The ratio between median and average income is widening. You'd expect a gap, but depending whether you use labour cost index, quarterly employment survey, or linked employee-employer data, somewhere between 63 and 77% are earning less than the average wage. So that's the sort of dispersion we've got. The market income in real terms of the bottom half was static between 1998 and 2010. And in case somebody's going to say, yeah, those on high incomes are paying most of the tax, well, that's because they get most of the income. It's a circular argument. So $2.20 paid out, say, 10 times a week is incidental for some people. You'll get the cup of coffee argument. But for other people, it is a meaningful cost. And arguably for congestion, you'd need rates that are much higher than that. We've got relatively high levels of car ownership with 0.58 cars per person in 2005, and even lowest decile households average 1 car. And of course they'll have a higher proportion of income going on transport costs. And Bonsall and Kelly argue that trips for work, education, hospital appointments, sport and cultural participation, connection with family members and so on are examples where people have got limited flexibility. And with the London congestion charges, there are some exclusions, but they would not, for instance, extend them to low-paid cleaners, such as travelling in unsocial hours, as it was thought the employer would reimburse them for that. Yeah, right. Okay, a petrol tax is already regressive, but depending on the method used, additional charging impacts negatively on low-income users. And I looked at John Walker from the Royal Automobile Club, using numerous studies arguing that road pricing is less regressive than tax, but also cites studies showing hardship for a proportion of low-income car users. So there's a distinction between low-income and low-income car users. However, I believe one of the strongest arguments against road pricing or charging is that it leads to social exclusion and separation. The rich not only have their flash homes, send their kids to the private schools, but they'll have their own roads, or lanes at least. And this literally cements division in our society. And there's a big literature on well-being, social exclusion and transport disadvantage. So transport is crucial for participation. So there is a risk that you develop gated communities right in the heart of your city. And then the second order effects as new motorways cause greater dispersion, which affects employment opportunities and the viability of public transport. And of course, the diversion of traffic can impact negatively on some communities. So that's where you get the spatial mismatch issues, etc. So as you can see up on the screen, this was an American study. I think there's something suspect about welfare analysis that uses gross disparity of income to calculate relative costs of time and therefore justify charging on that basis. So you use massive inequality of income to price time to calculate the benefit that therefore accrues to those people with the income as to why it all works out in the end. And you know, it's kind of market clearing argument, those that can afford it pay. So this is the problem that you have. You build inequality on top of inequality with this sort of argument. And prices can rise steeply. In London, that started in 2003 at £5, but was up to £8 already by 2005. Now, major transport infrastructure projects are fraught with risk, and given the cost of borrowing is cheaper for government and the risks that exist around lower usage than anticipated, alongside all the sunk costs, I also argue it's better for the government to carry that risk, those risks. And the risk is that if charging options develop a momentum to proceed, then we automatically enter a world where the transfer of that risk from the government comes through in terms of subsidies and other things like that, which I'll get to in a moment. Now, there's evidence of heroic assumptions and biased analysis. An analysis of toll roads in Australia by Peter Davidson claimed that the modelling had been poor, with many roads attracting half their projected volumes, and this was due to biased analysis, quote unquote. And someone writing about the Cross-City Tunnel in 2009 said, outside peak hour, a trip through the tunnel can verge on the hallucinogenic. It is as if you are the last motorist in the world racing along a gleaming neon-lit tunnel like a kid in a video game parlour until the unnerving apparition of another motorist jolts the senses. This is a fine bit of engineering, but as a business proposition it went bust a long time ago. They banked on 90,000 vehicles a day. The reality was a third of that. Brisbane Connections predicted 135,000 trips a day, rising to 291,000 in 2026, but it was 66,000 a day in October last year. Then there's the deadweight loss. up to 60% of toll revenue can be used to pay for revenue collection. And in the London congestion schemes, the costs are 42% of revenue. And another UK study by the Department of Transport modelled anywhere between 25 and 64% on transaction costs. Rachel Alexander, not someone I normally look at, editor of the Intellectual Conservative, very strongly critical of disastrous projects such as the Big Dig project in Massachusetts, and she also argues very high transaction costs, and she was also very concerned about the privacy issues. I guess that's the new normal, ask Angela Merkel, but you know, there's that issue as well about the scanning, etc. And the level of the charge can reflect the higher cost of private finance where they enter into it, and that's where a lot of the risk starts to shift through that price mechanism, through concessions and through subsidies, so that the government gets caught with that. And there is also evidence that congestion can be shifted rather than reduced. Now, in terms of the Northern Gateway, I saw that it was built 10 years earlier because they borrowed 158 million. It is an interesting model because if I understand it correctly, it's essentially a state agency, NZTA, that they took on the debt. And so it costs, their net operational cost is 65 cents out of $2.20 or $4.40. And from what I can see, others in the room will probably know more about this than me, they do appear to be reasonably on track towards raising that 158 million out of 356 million. Although I do notice that in 2011 there was 700,000 in fines written off and 5 people owed nearly 10,000 between them. So it meant that it was built 10 years earlier, and again, when charges went up in March 2012, NZTA said the increases are regrettable but necessary to ensure that the toll road remains viable and on track to repay its debt within 35 years. So there's a distinct risk of the charges increasing and worsening equity effects in these road pricing models, and arguably the prices may have to be much higher than what we've seen so far to really reduce congestion. So my little bit of insurance, if you do decide to vote, not only that I'm a terrible debater, but also that my opposition in this moot is completely out of sorts, then I agree with Geoff, there are things that can be done. And so there are things such as exemptions and revenue recycling towards targeted redistribution. Locals could be exempt or have a reduced rate. I note that in some of the survey questions in Auckland, there were very high positive responses, but for instance, one of the questions was, would you support user charges that lead to more public transport and reduce congestion? So in other words, it was very much a loaded thing that's what the result was going to be. So clearly you can segment people, you could have cars with 3 or more people exempt. Obviously the issue of alternative roads is a huge equity issue. And improve public transport options. So clearly if you did raise revenue in this way and the money was being poured back into public transport and other things, then that would mitigate some of the things that I have been talking about. Now I have rather rushed through. I'll perhaps slow down for a moment because I see that I've still got a few more minutes. So alternatives in terms of the capital issues. Now, they're clearly the obvious ones. There's debt. One of the issues I've been thinking about is in terms of the super fund, fund investment vehicles that there's been a bit of discussion on, a bit of legislation on recently, or other forms of development funds. And I note a report last month from the OECD on large pension funds and long-term capital investment and saying why can't these be more aligned? And a recent economist discussed how much greater use could be made of pension funds linked to development funds. Now, of course, this isn't the same as direct public debt, and someone has to pay somewhere along the line. But there could be more imagination around development bonds and that sort of thing in terms of public infrastructure. So my argument is we should not use charging to get dubious projects over the line. If the public benefit is low, then don't proceed. And if a major rationale for Transmission Gully, for example, is that it's a lifeline, should we need it on a long-term basis, then accept that we all pay for that lifeline in the wider public interest. That is a public interest. that applies to everybody. I do notice the Greens say that if there was charging for it, it would be $15 a trip, and because the patronage is not there. Now, clearly there's wider policy considerations on housing, environmental impacts and so forth, and that could impact on decision-making around major infrastructural projects. So if, for instance, petrol tax was used increasingly to pay for improved public transport, that could be part of a more equitable approach, but similarly to, as I observed before, that sort of targeted redistribution, both to disadvantaged communities and to public transport, are the sorts of things that are going to have to be looked at. Now, I do just discuss briefly congestion. So let's be frank about what the pricing actually does in terms of congestion. It uses a price mechanism to deter some people. Now, I do acknowledge that that means it will deter some people who could well afford to pay that price, but choose not to at that time because it's not an essential trip. So it does have an impact at that margin. But what it's also doing is it's deliberately trying to exclude people who are adversely affected by the price to be paid. I mean, that's exactly what it is trying to do. It's explicitly targeted at low-income people. That's where it will have the greatest deterrent effect. That's what it's designed to do. And so that's the same that we actually have around things like cigarette smoking or something like that. And I can understand the arguments around that, and you can look at public welfare benefits that would flow from deterring people from smoking. But I do think we need to be quite upfront, and you know, we saw the Russian queues earlier. This is a queue by income. That's what it is. So there's many risks with relying on price mechanisms. Emissions trading scheme is an example. So maybe we need to focus a little bit more on some regulatory options. Now, when I put that down, I thought, no, Peter, you're not going to advocate carless days. So I'm just making the point that we, as economists, and you know, we get myopic about price. Of course, it does make a difference. Of course, it's going to make a difference. But if it's simply dividing the community into those for whom say, well, that extra price just simply doesn't matter to me. It's just another cup of coffee. I don't give a damn. I don't have to alter my behaviour at all. So I get the non-congested road. And then there's other people for whom it does make a difference. They get the diversion, they get the disadvantage, they don't get to ride on the road, they get the spillover negatives, and then they end up in the situation that they are worse off. And that's a very bad outcome. So clearly this isn't a simple area. As I've kind of read up for this, I've seen examples where people have invested, cities have invested more in public transport, and as congestion got down, a whole lot of people decided they'd bring their cars in who weren't before. So it's never simple. There are options of more freight, for instance, by rail or by sea. So in conclusion, I think public economic development goods are best to be publicly funded. There are equity issues, and they include the problems as a society we encounter by deliberate policies of social exclusion. There's risks in terms of implementation, and there's very, very high transaction costs. There are other options available, and if additional charging is used, then we should choose the more equitable options with targeted redistribution and exemptions that can apply. Thank you very much.
Thank you, Peter. When I grab the mic from you.
Oh, yeah, sorry.
Peter's comment about privacy associated with the software to do with congestion reminds me of a colleague when I was working in London who complained bitterly that he'd been fined or was getting a fine because of a speed camera, actually, rather than a congestion charge camera. They have vehicle recognition software in London to pick up non-charge pairs. His complaint was that the UK, of course, allows you to challenge any speeding fine by asking to see the photograph so you can verify who the driver was. Some of you may remember one or two famous politicians who fell foul of that by getting their wives to take their speeding fine. So he asked for the photograph to make sure that it actually demonstrated he was driving, and was unfortunate to discover, as he said to me, not only could he recognise himself, he could recognise that he was putting a CD into the CD player in his car, and he even could tell which CD it was that he was putting in. On that note, Chris.
Thanks so much. Oh, I've just managed to break the microphone as well. Hopefully this will pick me up down here, Cherry. I'll have to speak louder. Okay, I guess in terms of framing the discussion and acting as commentator on this to enable you to help choose between these two gentlemen here, I guess I wanted to frame the discussion in terms of sort of three key questions. Firstly, what does time actually mean? Are we talking about now, never, or at some stage in terms of charging for public infrastructure, namely roads? Secondly, what are we actually charging for? And by that I mean, are we clear firstly that there is an underlying rationale for charging as opposed to a general slush fund, and that we can also identify the components of the charge? Now I'll get onto that in a minute in terms of what we're actually talking about here. And thirdly, are we actually clear what we are charging for is actually, the directly charging is actually the best response once we are clear about what we're actually charging for? And I guess in looking at the status quo, there's kind of four questions that always troubled me, that I was looking for Peter and Geoff to kind of take me through and kind of convince me that actually there's a compelling need to move or not to move from it. And firstly, it seems to me that in our revenue and pricing system in transport, we're increasingly relying on that system to achieve a multiple set of policy objectives there. So we're starting to encourage the purchase of electric vehicles and things like that through the revenue and pricing system. Secondly, the intergenerational inequities associated with our funding system are acute when you start talking about the investment for major infrastructure. So our current system, it's a pay-as-you-go system. We do as much construction in any one year as we collect from the transport revenue system. And really what that means is, it works well if you're bashing a few corners here and there and trying to fix a black spot or putting a passing lane on State Highway 1. But when you're talking about these multi-billion-dollar public infrastructure projects, my question is, I guess, is it fair that you as road users of today pay for something that somebody's getting benefit from 40 years hence? Thirdly, I guess we have a very good system at the moment. It's efficient, it's great at collecting stuff. So our paper-based licences like road user charges, or just taxing stuff as it comes out of the bond store, it's really efficient, but that technology's moving fast. At what point does that net efficiency switch over into a kind of a directly charging perspective? And I guess thirdly as well, and this picks up on Geoff's point, the sustainable networks actually require charging at point of use. And I guess I just wanted to show you one particular thing that we've kind of collected together and been pondering over through the last few years. And this is data collected from US cities. And the question that we've asked ourselves is, can you actually build your way out of congestion? Now, what we've got here is we've got the horizontal axis is basically the percentage population increase in a US city minus the percentage of urban lane miles that they've added over the last 30 years. So what we've got is we've got a situation where the people to the left of the vertical axis are the net investors. They're outbuilding their population increase. The people to the right of it, they're not outbuilding their population increase. But what we're seeing is everybody's losing time. And I feel very sorry for San Antonio up here. They've massively outbuilt their population increase, but they've had a 1,200% increase in lost time over the last 30 years in terms of their road network. Interestingly, Palm Springs, so there's 3 US cities that we've monitored that are below, that are actually winning the battle against congestion relative to their population increases. Palm Springs, it's a retirement community. There are lots of retired people moving there. Those people don't travel at peak times. Portland, they stopped building roads. They invested heavily in their rail network. That said, they're only just keeping their head afloat in terms of lost time. And the last one, Detroit. Now this is a 30-year picture. Detroit is now somewhere down here because the city's dying and its population's not good. So I guess that's a key point. Yeah, I guess the next point is really that direct charging is happening right now. It's increasing and it's carrying on, and there's proposals that have come through, but there's also proposals that have failed and failed miserably. A lot of the UK stuff never got across the line and we're stuck with London. And then there's the recidivists like Auckland and New York. But there's also a significant pipeline of potential schemes right through the world. So this is something that is happening, it's increasing, it's gaining momentum. Now I guess I just really, in terms of framing the debate as well, really wanted to be clear about what we're actually talking about here. And we've been talking about roads, but I just wanted to put it in the context of other networks, other infrastructure economics and so on. And with the hypothecation of the National Land Transport Fund in 2006-2007, we now have a degree of clarity across the infrastructure landscape about what's actually being paid for. Now the point I'd make here is that power and telecommunications are ones where we pay for use. You get your bill and so on, and you pay, depending on your scheme and things, but you always end up paying for it no matter which way you look at it. You pay more during peak times, you pay less during non-peak times. Public transport, you pay to get on the bus, you pay to get on the train. Roads and the three waters, effectively, we're not paying for use at point of use. Now there'll be some people who will probably quibble with that definition, but I guess my point is there's two key tests for me here. It's like at the time that I want to use it, you can't stop me. So at the time that I'm flushing the toilet or opening the tap for a drink of water, you can't stop me from doing that. Same with the car. The only way you can stop me from getting on the road is not to, well, in terms of me having not paid, is not to fill up my car. You know, we're collecting revenue through the fuel excise duty. So you can't stop me at the point of time that I want to use it. And secondly, I mean, there's no clearly identified service or use charge in these areas. So I just really wanted to talk and zero down to the fact that we're talking about consumption here of the asset, not construction or maintenance in terms of charging for existing roads, because we already charge for construction and maintenance. So I guess in terms of the arguments summarised, we talked firstly about efficiency, and Geoff talked about the fact that it's critical to managing long-term service levels on the roading network and getting a better modal split. He also talked about a way of fairly apportioning the costs where they lie, particularly, and he showed that diagram where that last 5% traffic on the road. The externality costs are not linear here. It's that last 5% that caused the problem for everybody else. So I guess the question is, what do you do to get, the maths are simple. You can only fit 25 cars per lane per kilometre on a road. It becomes gridlocked at that point. But the impact of that 24th car is far greater than the impact of the 23rd car. The impact of the 23rd car is far greater than the impact of the 22nd car. Once you get below about 18 cars, it all starts flowing pretty freely. So what do you do to get those last couple of cars off the network? And as I've alluded to and Geoff's talked about, a more sustainable funding path that better captures evolving markets. Peter talked about rationing through prices, and it will actually reduce mobility, and therefore, given New Zealand's circumstances, and Peter's right, New Zealand's different to London, it's different to Stockholm. There will be economic costs associated with the reduction in mobility. And that's all to do with the generalised cost of transport. Buying a car, owning a car in New Zealand is cheap. Using public transport in New Zealand is actually pretty expensive. Secondly, the ability to restrict access at point of use means direct charging is suboptimal from a revenue perspective. And thirdly, there's high transaction costs, and Peter alluded to them several times, and they are significant. When you compare them to, say, just levying funding out of the bond store or getting somebody to prepay their road user charges, the transaction costs at the moment, London works at about, as Peter said, about 42%. Some of my colleagues in PwC London are taking about 50% cost out at the moment, but they're significant. The equity side of things, Geoff talked about unrationed network use leading to suboptimal outcomes, particularly with those with higher values of time. But I would suggest it's everybody. that it actually suffers because there's no discipline on the use. And those that don't create the externality cost actually overpay. So the person that's on the harbour bridge at midnight is paying the same as the person that's on the harbour bridge at 8 a.m. And as Peter talked about, we've already paid, in terms of the equity side of things. And you could actually mount an argument that our networks are actually geared towards a level of service at the particular level. So why pay again for that level of service? And Peter's critical point really was the alternatives are critical here. Now, a couple of quick questions, and I know I'm running short of time. But does anybody know how you get from Johnsonville to Seaview via public transport? Well, how many buses run from the Hutt Valley to Whitireia Polytechnic? There's 2 buses a day that do that. So the point is that our public transport network and our public transport alternatives are geared towards delivering professional people into city centres. They're good radial transport networks. They don't service the lower income, lower area communities as well. And that's an origin destination issue. But as Geoff and Peter both point out, there's some other critical things here, and there's some commonality. The proof is in the pudding. Some of these schemes can be disastrous, some of them can be extremely successful. Both London and Stockholm have survived changes in mayors and violent shifts to the left and the right. They've been successful, but as Peter points out, there can be some multi-million dollar and sometimes $100 million disasters associated with it. But the important thing is these aren't answers on their own. It's putting them into the New Zealand context. And with that, I'll just leave you with a couple of points to ponder about when you look at these guys. Direct charging doesn't wholly replace the current funding system, so is it a good complement? And the shift in emphasis has to be better than the alternatives, namely funding, network efficiency and equity. Thank you.